Hi everyone, I'm Sean, Head of Investments at Endowus. With me is Yuhan, one of our investment leads from the Endowus Investment Office.
For those who are new to us, Endowus is Asia's leading fee-only wealth platform that offers advised investment portfolios and funds across both Singapore and Hong Kong. We were the first to introduce 100% cashback in trader fees, allowing us to be independent and fully aligned to our clients' needs by not receiving kickbacks or commissions.
We want to help you invest better to live better. And we aim to do so by offering expert advice with access to solutions that were once only reserved for large institutions at low and fair fees.
Today's session will include a brief market recap, key updates on what lies ahead, and how our portfolios did. First, let's examine how the markets performed in Q3. Having staged a strong rally in the first 7 months of the year, consecutive losses in August and September brought markets firmly back down. Optimism over the likelihood of a soft landing was replaced with fears over a renewed hawkish Fed stance, while persistent issues with the Chinese economy erased any lingering hopes that a robust recovery could help bolster the global economy. The major developed markets of the US and Europe both suffered declines over the quarter. Potentially higher interest rates for longer led to weakness in the US technology sector, while in Europe, the consumer discretionary sector sold off on fears of the impact to discretionary spending. Consistent with the reversal in market sentiment, growth stocks underperformed their value peers, although on a year-to-date basis, the MSCI Equity Growth Index remains well ahead of the MSCI Value Index. Moving on to fixed income, the global fixed income market saw a series of significant developments in the third quarter, sparking concerns and raising questions about the future of fixed income investments. The surprise downgrade of the US by credit rating agency Fitch garnered public attention, with the turbulence within the US amplified by renewed brinkmanship around its debt ceiling and political discord in the House. Inflation fighting remains the central theme, with bond prices declining in most developed markets, as the realization set in that rates may remain higher for longer. This continued a recent pattern of positive correlation between equity and bond markets. While the steepness of the yield curve's slope has since moderated from its peak earlier this year, it continues to be inverted. Corporate bonds outperform government bonds, with the riskier segment of bond markets faring better than its higher quality peers.
Let's now discuss what investors should be watching out for in Q4. First, on the Fed, the latest September Federal Open Market Committee minutes indicate one more rate hike coming before the end of the year. This suggests that both economic conditions and inflation concerns remain on the Fed's radar, motivating them to advocate for a continued tightening of monetary policy. The outlook for 2024 is equally noteworthy. When we look at the Fed dot plot, it suggests a period of sustained higher interest rates. Both equity and fixed income markets, which had already been nervous since August, reacted negatively to the relatively hawkish tone from the September meeting. Long-term Treasury yields rose further, driving bond prices down, and equity returns took a nosedive. Thus, further uncertainty lies ahead in the second half of 2023. Investors will assess how central banks balance between a growth pullback on one hand and cooling inflation on the other. To top it off, there are no shortage of dramatic headlines to keep investors fearful or exuberant. On fixed income, one question on many investors' minds is, can fixed income be fixed? Investors seeking safety in fixed income this year would have been disappointed by the meager to flat returns returned by the broad fixed income market. If we look at the Bloomberg Global Aggregate Index, it has seen close to no returns in Sing dollar terms thus far this year. Yields for cash and money market instruments have also risen along their longer duration peers, leading many investors to forsake longer dated bonds for the security and liquidity of treasury bills and money market funds. While holding on to cash investments may seem prudent in the current market environment, the yields for broader fixed income instruments beyond money market and treasuries are attractive versus history, and thus may represent an investment opportunity for long-term investors who can consider taking on some credit and additional duration risk. While the higher for longer interest rate narrative may continue to drive fixed income and equity markets, keep in mind that in flat or falling interest rate periods, bonds have typically outperformed short duration treasury bills. It is hard to predict how long the Fed will keep interest rates high, but when the economy starts to deteriorate, interest rates are likely to drop, driving bond prices up. The equity market picture is a little more mixed. The US equity market saw a strong first half, a turbulent third quarter, where growth underperformed value, but is still outperforming year to date. The higher rates for longer narrative put pressure on the prices of the Magnificent Seven, but they continue to drive a large part of market performance. All in all, this reminds us that the market remains, as always, hard to predict, and thus the prudent choice in our view is to have a globally diversified equity portfolio that makes up most of your investments, and if you like, you complement this with a tech fund or an actively managed fund. This is known as a core satellite investment approach.